It's 9:14 in the morning. Your app is open, your fingers on the button, and so is everyone else's. Across the country, a few million people are about to tap by in the same handful of seconds. This is Zerodha, and this is everything that's actually behind that one tap. Every trading day in India starts with the same stampede. The market opens at 9:15 sharp, and it's not a gentle ramp, it's a wall. All night things pile up, news breaks, results come out, people queue orders before dawn, stop losses sit there waiting, and every one of them wants to fire the instant the bell rings. So at 9:14 and 59, the system is calm. At 9:15 exactly, a whole day's worth of pent up decisions arrive at once. Same second every day. Most apps never face a moment like this. Zerodha faces it before breakfast 5 times a week. One number first, so you know the stakes. Zerodha has more than 1.5 crore registered clients. And at its peak back in 2021, this single broker was over 20% of all the stock trading happening in India. One app, a fifth of the entire market's activity. That's the load hitting 9:15. Not a startup's traffic, but a meaningful slice of a national market, all funneling through one company's systems in the first seconds of the day. Now, the one idea that reorganizes everything. When you buy a share, Zerodha does not sell it to you. Zerodha never sets the price and it never matches your trade. Here's who actually does what. Zerodha takes your order, checks it, and routes it. The exchange, NSE or BSE, is where your buy meets someone else's sell and where the price is decided. Then the clearing corporation works out who owes what and settles it. A depository called CDSL is where your shares actually sit, and your bank is what moves the money. Five players, and Zerodha is just one of them, the on ramp. It's the fast, reliable front door to a market it doesn't own. Why does that matter for engineering? Because you can only scale what you control. And the piece Zerodha controls is the routing. Getting your intent to the exchange correctly faster than the person next to you. Before we open anything up, let's put the whole thing on one screen. This is Zerodha, end to end. Up top, your devices, the Kite app, and the outside apps that plug into Kite Connect. Everything they send hits the edge, a load balancer and fans into Zerodha's core, a fleet of stateless Go services. The API that takes your requests. Veto, the risk engine that vets every order. The ticker that streams live prices back out. And the watchers sitting on your standing rules. Orders flow down through the OMS cells, out a leased line to the exchange where the actual matching happens, outside Zerodha's walls. Underneath sits the data plane, Postgres, Redis, and Kafka, the memory of the whole system. And off to the side, the rest of the outside world, the clearing corporation that settles up, the depository that holds your shares, and the banks that move the money. That's the map. Every box has one job. For the rest of this video, we zoom into each one and see how they combine to make a single tap work. So what is Zerodha engineering wise? It's not one program, it's a set of separate machines, each solving a completely different problem, all wearing the same app. Watch. The kite screen, splits apart. There's the machine that executes an order, a different one that streams live prices to your screen, another that watches the market for you and fires when your condition hits, one that moves your money in and out, one that keeps track of where your shares actually live, and one that runs every night to reconcile the whole day and mail you the paperwork. Six machines plus a dozen more we won't have time for, like mutual funds, IPOs, account opening, and pledging. Each of those is its own machine, too. We're going to open each one with the same four questions every time. What does it do? What's it built from? How do the parts combine? and what keeps it standing at 9:15. Machine 1. You tap buy. Where does it go first? Not to one big server, that would be a single point of failure and it would melt at 9:15. Instead, your tap hits the edge, a layer of load balancers whose only job is to spread requests across a fleet of identical servers behind them. Any server can handle any request because these servers hold no personal state of their own, they're interchangeable. That's the first big idea, and you'll see it everywhere. Stateless services behind a load balancer. Because they're interchangeable, you can just add more of them. And Zerodha does exactly that. It scales the fleet up in the minutes before the bell. So the wall at 9:15 hits 100 open doors instead of one. Before your order is allowed anywhere near the exchange, it has to pass one gate. And this gate is clever. Every buy has to be checked. Do you have the money or the margin to actually cover this? If Zerodha lets through an order you can't fund, Zerodha is on the hook for it, not you. So the check has to be right and it has to be fast. Because at 9:15 there are a lot of them. Zerodha built its own engine for this. They call it Veto. It sits in front of the order system like a bouncer. And here's the trick. It doesn't go and ask a database how much margin you have for every single order. A disk lookup would be far too slow at peak. The numbers it needs are pre-computed and sitting in memory, ready. The check happens in milliseconds, in RAM, before your order costs the exchange anything at all. That's the pattern. Do the expensive thinking ahead of time and keep the hot path answer in memory. Orders approved. Now it has to actually reach the exchange, and two things stand in the way, both about surviving load. First, the order system itself isn't one block, it's split into cells. Zerodha runs several independent copies. If one cell has a bad morning, it takes down the slice of users on it, and only that slice everyone else keeps trading. That's called a bulkhead. The same reason a ship has sealed compartments so one leak doesn't sink the whole vessel. Second, and this is the real bottleneck, the connection to the exchange is a leased line, a physical pipe with a fixed capacity, only so many orders per second no matter how much money you throw at it. When more orders arrive than the pipe can take, they queue, they wait their turn. That's why brokers cap you on Zerodha 10 orders a second per account. Not to annoy you, it's admission control, rate limiting at the front door. So the pipe downstream never gets a flood it can't drain. Through the pipe, now the exchange does its job. The one thing Zerodha never does. It matches your buy to someone's sell and stamps the price. Your order comes back with an exchange order ID, proof it's real. The whole round trip, around 40 milliseconds on a normal request. But here's the thing about 9:15. Averages lie. What matters is the slowest orders, the P99, meaning 99 out of 100 finish faster than this number. And it's that worst 1% you actually design for. And what about retries? Networks drop messages. If your app doesn't hear back, it might resend. So every order carries that ID like a fingerprint. Send it twice, and the system recognizes the duplicate and refuses to place a second trade. That property has a name you'll hear all season, idempotency. Do it twice. It still counts once. Panic tap by 5 times on a frozen screen, and you get one trade, not 5. Finally, the confirmation flies home and it writes back on the same live connection that streams your prices, which is machine 2. Your screen says complete and your phone buzzes. Machine 2. The numbers on your screen flickering, updating many times a second. This is a completely different problem from placing an order. An order is one message you send. A price is one update the exchange sends. That has to reach everyone watching that stock, hundreds of thousands of screens, all at once. That shape has a name, fan out. One write, an enormous number of reads. You saw it in the Instagram and YouTube episodes, and here it's live market data. The scale here is wild. On one heavy day, the election results in June 2024, Zerodha's systems were pushing around 175 million price ticks per second out to people's screens. And here's the flex, that fan out isn't some giant cluster. It's essentially one lean program, written in Go, holding hundreds of thousands of live connections open at once, and firing updates down all of them. Boring technology, ferociously well built. Quick one, but it's the kind of detail that separates a system that survives from one that falls over. At 175 million messages a second, the shape of each message stops being a detail and becomes the whole ballgame. So Zerodha doesn't send prices as friendly, readable text. A price tick at its smallest is 8 bytes. Just the numbers, packed tight, nothing wasted. Send that same tick as ordinary web text and it's 10 times bigger, 10 times the bandwidth, 10 times the cost at every one of those hundreds of thousands of connections. At this scale, the encoding is the architecture. Machine 3 is my favorite because it's built entirely out of the first two. You can't stare at the screen all day, so you leave standing instructions. Alert me if Reliance crosses 2500 or a GTT, good till triggered, meaning if it hits that price, place my order automatically and that instruction can sit there waiting for up to a year. How does that work? There's a durable store holding everyone's standing rules, millions of them, and there's an evaluator that subscribes to Machine 2's price fire hose, the same tick stream we just built. Every tick that comes in gets checked against the rules waiting on that stock. This is event driven, nothing polls, nothing loops asking is it time yet. The tick arrives and it wakes the rules that care about it. When a rule matches, one of two things happens. Either it notifies you, a push, an email, or for a GTT, it reaches over and injects an order straight into machine 1, the execution pipeline. It's a feature stitched together from the other two machines' parts. One honest caveat, because it trips people up and it's good engineering to be clear about it. A trigger firing is not the same as your trade happening. When your GTT hits its price, it doesn't magically fill. It does exactly one thing. It places a normal order into the pipeline, right then, at that moment. And that order leaves for one day, like any other. If the market moves too fast and there's no matching seller at your price, it just doesn't fill. The trigger did its job, the market didn't cooperate. So, a GTT is a reliable reminder that places an order. It is not a guarantee of a trade. The system is honest about the boundary between what it controls and what the market controls. And a well designed system never pretends it controls the part it doesn't. Machine 4, moving actual money. And this is where the rules of the outside world shape the architecture more than any clever code does. Adding funds. You'd think just accept a UPI payment, done. But watch the constraint. Zerodha can only credit your trading account instantly if it can be certain the money is yours and came from your registered bank. So UPI works, but only when you start it from inside the Kite app, where Zerodha generates the request and can match it to you exactly. Send money from a random UPI app to some ID and it bounces back. Not a bug. It's reconciliation. Every rupee coming in must be tied to a known source account or it can't be trusted. And there's a hidden cost Zerodha eats. When you add money by net banking, the payment gateway doesn't actually hand Zerodha the cash until the next day. But your trading balance goes up instantly. So Zerodha is fronting you the money for a day, out of its own pocket millions of times over. Instant for you is a loan underneath. Getting money out is even more revealing because it exposes a deadline built into the market itself. When you sell a share, the cash isn't real yet. India settles trades on what's called T plus 1. So the money from your sale actually arrives one working day later from the clearing corporation. Zerodha literally cannot pay you money that doesn't exist in its hands yet. That's why a normal withdrawal isn't instant, it's a batch. Requests collect all day and at a fixed cutoff, 10 at night on weekdays, they're processed together and sent to the banks. Batching like this is deliberate. One clean, reconciled run instead of thousands of risky one off payouts. There is an instant option now. And look at exactly when it's allowed. Only when you've placed no trades that could still be unsettled. Only whole rupee amounts. And once a day. In other words, instant is offered precisely when Zerodha can prove your free balance without waiting for the day's maths to finish. The eligibility rules aren't fine print, they're the architecture showing through. So, where does your idle money live while it's with Zerodha? And here, India does something most countries don't. By regulation, your cash never mixes with Zerodha's own money. It sits in separate, ring fenced client accounts. But it goes further. Every single night, brokers have to push client money out to the clearing corporation. It's called upstreaming. Zerodha doesn't get to sit on a giant pool of everyone's cash overnight and earn on it. At the end of the day, it's swept upward out of the broker's hands. And a few times a year, any money you're not actively using is automatically returned to your bank account, whether you asked or not, the quarterly settlement. On the day it runs, the whole industry moves more than 25,000 crore back to customers in one coordinated sweep. Hold on to this because it's where we're heading. The broker is being designed to hold as little of your money as possible for as short a time as possible. Machine 5, your shares. And the surprise here matches the cash. Zerodha doesn't hold those either. Your shares live in a demat account at a depository called CDSL. Zerodha is just the participant that opens the account and shows it to you. The actual record of you owning 10 shares of Reliance sits at the depository, not the broker, which leads to a lovely little security detail. When you sell, the shares have to be taken out of your demat account, and Zerodha can't just do that on its own. It needs your authorization, verified by the depository directly, either a one time permission you granted at sign up or a fresh one time password from CDSL for that specific sale. The debit of your shares is gated by the depository, not the broker. Even your own broker can't move your shares without the depository agreeing. So, if the exchange only matched your trade and the depository holds the shares, who actually swaps the money and the stock? That's the clearing corporation, and what it does at scale is staggering. It sits in the middle of every trade, using a trick called novation, becoming the buyer to every seller and the seller to every buyer. That means it can take a whole day's tangle of millions of trades and net them down into who, on balance, owes what. Only the net moves. It's the same netting idea from the UPI episode at market scale. And recently it got cleaner still. As of late 2024, when you buy, the shares are delivered straight into your demat account by the clearing system, skipping a step where they used to pass through the broker's pool first. The broker is being cut out of the custody chain on purpose, one leg at a time. Machine 6 runs when the market's closed and you're asleep, and it's the reason your app feels instant in the morning. All day, trades pour in. Overnight, a batch job crunches the whole thing, every trade, every user, into your final positions and your profit and loss. That lives in a huge database, a PostgreSQL warehouse holding hundreds of billions of rows. It's too big for one machine, so it's sharded, split across several, each holding one slice. So no single database ever has to answer everything. But here's the clever part for the morning rush. Your app doesn't read from that heavy warehouse at 9:15. Overnight, the numbers you'll need are pre-baked into a fast in-memory cache Redis. So when you open Kite and see your holdings, that's a memory read, milliseconds quick. The slow warehouse never even feels the morning stampede. It already did its work in the dark. And then every single night, Zerodha has to do something the law demands: send every customer who traded a signed contract note, the official record of their day. On a busy day, that's over 1.5 million documents, generated, digitally signed, and emailed. The old way took 7 8 hours. The rebuilt version does it in about 25 minutes. How? The same ideas one more time. Do the work in parallel across many small workers. Spin up around 40 temporary machines just for the run. Then throw them away when it's done. You pay for the muscle for 25 minutes, not all day. And self host the boring parts like the mail servers. So, a million emails an hour is your problem to tune, not a vendor's rate limit. It's not glamorous. It's a factory that runs while the city sleeps. But it's the machine that makes your records are always correct, quietly true. So back to where we started. 9:15. Here's what makes it the hard problem, stated plainly. Every machine we just built is fine on its own. But at 9:15, two of them get slammed at the same instant. The order machine takes a whole day's stored up decisions in a few seconds, and the price machine has to fan out the most volatile prices of the day to every screen at once. And it's worse than random traffic because it's synchronized. The overnight orders were all told wait and go at 9:15. The stop losses all watch the same opening prices. It's not a bell curve of demand, it's a wall. A whole country deciding on the same tick of the same clock. That's the thing a broker can't scale its way around with more servers alone. Because the real limit isn't Zerodha's computers, it's that fixed pipe to the exchange. This isn't theory, it's happened. February 27, 2019, right in that 9:14 to 9:20 window. And here's the twist that makes it a perfect engineering story. By then, Zerodha had built most of its own order machinery in house. About 90% of the load ran on systems its own engineers controlled. The other 10% still ran through a piece they licensed from an outside vendor. Guess which part broke? The rented piece buckled. Orders backed up. Several lakh of them piled up, stuck at validation pending, unable to reach the exchange. And Zerodha's own team couldn't fully fix it because they didn't have the keys to someone else's black box. The weakest link was the part they didn't build. So look at what they did after. They scaled the order tier from 13 servers to 58, 14 leased lines to 44, a wider pipe, 8 independent cells, and they started building their own order system to replace the rented one entirely, plus a deliberately hybrid setup, bare metal machines sitting right next to the exchange lines for the order path and the public cloud for the app around it. Each failure taught them exactly which piece to own next. So let's put the machine back together. One tap at 9:15 and behind it a fleet of interchangeable servers, a risk gate reading from memory, cells and a rate limited pipe to an exchange that does the actual matching, a lean program fanning prices to a million screens, watches built from the other machines, money and shares that the broker barely holds, and a factory that reconciles all of it while you sleep. And that last part is the quiet punchline. After the nightly upstreaming and the direct payouts, Zerodha ends most days holding almost none of your money and almost none of your shares. It's not a vault, it's machinery, routing, checking, streaming, reconciling. Run famously by a tech team of only around 30 people on boring, sturdy tools. Zerodha's Stampede runs on a clock, the same second every single day, and you can build for it. But what about a Stampede nobody can schedule? 25 million people, one live match, all holding their breath for the same ball. That's Hotstar. Next time.